FirstRand expects to generate earnings in the second half that are similar to the first half, which rose by 6%. Outgoing CEO Alan Pullinger said that the group expects the economic environment and its markets to remain largely unchanged, characterised by high interest rates and elevated inflation. He will step down with effect from April 1st. That will see him hand over the reins to Mary Vilakazi, who becomes the banking group's first black female CEO.
I think we talk about it being a commendable result for the 6 months to 31 December. We pleasing call outs. I think in these results, we were able to grow our loans, customer loans, 11%. So that's kind of really healthy growth for us. And it's certainly a big pickup from where we were. We also saw deposits growing 11%, which I think is a very healthy sign for a bank, to see that we are being able to grow deposits. Where is that growth coming from, you might ask? On the loan side, it's really only 7% is going into retail loans, so I guess the consumer, and then 10% and 14% respectively into F&B, commercial and RMB. So it's really the smaller, medium-sized and large businesses that are taking the bulk of the lending at the moment, because the consumer's under pressure. So on the balance sheet, really good to see loan growth coming back. Net interest income is up nicely in the income statement, so we spoke about a good top line. All of this translated into a 6% growth in normalized earnings at a good return. So we're above 20% return on equity, and we were able to give our shareholders an interim dividend. So there's a lot to like in these numbers, but I suppose the real question to discuss is what's happening with credit and credit risk and credit charges, and how are consumers holding up in this environment. This combination of high interest rates and high inflation, I think, is really a tough thing for customers to bear. And there we are starting to see early signs of payment strain, which is fully understandable. So I do think in the next 6 months, you're probably going to see some loan growth slow down. And I guess as an economy, we're really going to be waiting for those interest rate cuts, which we are hoping for towards the end of this year.
Speaking of that pain and strain, I think for the past few months, as we talk about central banks, whether we're looking at the Reserve Bank or the Fed, a lot of the concerns have been around the lagged effects of interest rates. And you mentioned pain and strain there. How are you dealing with that pain and strain? And is it something that you are concerned about going forward for the second half of the year?
Absolutely. We are watching out for those lagged effects. So particularly in what we refer to as unsecured lending into the retail space. So things like personal loans, credit cards, overdrafts, I think those are often the products to react first to some strain. So we're keeping a close eye on it. And you know how it manifests. Often a customer might miss 1 month, then the next month they will make it up, and then 2 months later they would miss a month's payment. So you can see that there's erratic behavior on the repayment side, and that's something that we're keeping a very, very close eye on. I do think this point you've raised, Nastasia, around the lagged effect of interest rates. It's we've had now high interest rates for a couple of months. But the issue is they're probably going to stay with us for the duration of winter. And it may only be well into spring before we see some interest rate cuts. So the expectation is things are probably going to remain tough. And in fact, might even get a little bit tougher on the repayment side.
I'm curious to know, how well is RMB doing in the renewable finance space?
They're doing great. We spoke about, it was a couple of years ago, we put out an aspiration, and we said in this renewable space, we would like to do 200 billion of lending in total. And I think we spoke about 2026 or 2027. And then we broke it down into sort of chunks per year. And we said, okay, well, let's see how we go with that. And I think at the moment we're already over 100 billion of projects into this renewable space. A lot of it is into the private power. And those would range from, very large transactions with big sponsors, for example, some of the big mining groups, all the way down to, much smaller businesses who are doing a much more sort of localized plant. But really, we've been at it hard, I think, for the last 3 years. And I think we're already over 100 billion. So it's going well, and the pipelines look good. So, and I think all of the banks are really onto the story. And I think it's important from a country perspective, because the more we can kind of get these renewable projects certainly out there, commissioned, connected to the grid, I mean, I think it's just going to take pressure off Eskom, and hopefully for you and me, we have a better outcome on load shedding.
We tend to have at least a fair amount of assessment for the South African consumer based on what we're seeing on the economy side, but also in terms of what the Reserve Bank will be doing. Let's take things to the UK for a bit and look at your Aldermore side. The UK economy has not been doing great. What are you seeing on that front with that business, and what are the prospects?
Yeah, so, and it's a good point you make. I mean, if we look at loan growth in Aldermore, in fact, the loan books contracted. So here we grew, our loan books, as I say, 10%, 12, 14% in RMB, 7% in retail. In Aldermore, the loan books went back 4 or 5% in pound terms. And again, that UK economy is in a very tough space at the moment. So very significant interest rate hikes. They had a very, very big spike in inflation. It is starting to come down, but real rates are still very high. And certainly the Bank of England's not going to be cutting rates before the US Fed cuts rates. So I think we're in this wait and see story. So everyone talks about the middle of the year. We'll have to see who goes first. But I think it is tough there. Again, it's a cycle. So like all these cycles, better times will return. Importantly for us, we watch the property market. So a lot of the lending we do in Aldermore is around mortgages, it's around buy-to-let properties, it's commercial property. So we spend a lot of time looking at that property market. So the property market did come off, probably 7 or 8% over the last 12 months. It has bounced back quite nicely. And I suppose, there are a couple of dynamics in the UK which are helpful, I think, to the story. Number one, the labour market is very tight. So what I mean by that is in the UK, unemployment rate in the UK is probably 4 or 5%. So, I mean, we can't dream about an unemployment rate of 4 or 5%, but that's really where they are. I think it's great if you're looking for a job, because it means in the UK you're probably going to get yourself a job. But of course, from a business perspective, what it means, one, we have to pay our employees in the UK a lot. So wage growth has really been strong in the UK. And I think that's one of the features that I think has really helped the consumer get through these high interest rates, high inflation, is that they've been getting really good wage increases. And then the other point really relates to property. There is a structural shortage of property in the UK. And so demand for accommodation, either it's to own a property or even just to rent a property, that demand is so strong, and it way exceeds supply. And that really keeps, I suppose, an underpin to property prices, and then it also keeps rental high.